Welcome to The Explainer. Today, we're doing a deep dive into one single, absolutely wild day of trading on the Indian market. We're going to break down the extreme volatility using PR Sundar's post-market report, explore the big questions hanging over traders' heads, and figure out what it all means for the coming days. So let's get right into it. So you're probably asking, just how wild was it? Well, get this. The Sensex went on a massive 750-point intraday journey. It started by plunging 250 points. Then it completely reversed and rocketed up 500 points before pulling back again. I mean, a total roller coaster for anyone trying to keep up. And this quote from the source analysis just hits the nail on the head. It wasn't just volatile, it was genuinely chaotic. The market just couldn't seem to make up its mind, which created this incredibly tense, jittery feeling for traders. But what was causing all this confusion? Well, that brings us right to the heart of the matter. The absolute core of all this anxiety is the upcoming policy announcement from the Reserve Bank of India. The entire market is just holding its breath, waiting to see which way the RBI is going to jump. And this is where it gets really interesting because the RBI is caught in a classic tug of war. On the one hand, the governor himself has hinted that there's room to cut interest rates, which, would usually give the market a nice boost. But on the other hand, there's a huge reason to pump the brakes. And that big reason? It's the rupee. It just hit an all-time low of 90.41 against the US dollar. If the RBI cuts rates now, it could weaken the currency even more. So you can see why they're in a tough spot and why the market is getting all these confusing mixed signals. So, given this dilemma, what's the analysts' take? Well, the prediction is that the RBI is probably going to play it smart and avoid a direct rate cut. Instead, they might try to calm the market down with other tools. Maybe cut the cash reserve ratio, use some optimistic, dovish language, and just generally give assurances that they've got the rupee under control. It's a way to soothe nerves without making a huge, risky move. Okay, but here's the twist. In the middle of all this chaos and confusion, there was this one crucial point of stability. The Nifty index. It actually managed to hold a very, very important support level, and that was a huge deal for the day. Now, to really get why this matters so much, you gotta look at the backstory. The Nifty had been falling for 4 straight days. That's 5 red candles in a row, meaning the market closed lower than it opened for 5 consecutive days. Today finally broke that losing streak. So the first key number to watch was 26,000. Think of this as a psychological line in the sand. It's a big, round number that traders really pay attention to. And today, the Nifty fought its way back to close above it. But that was the psychological level. The really important number, the technical one that the pros were watching, was 25,850. That was the low point from the very first session of this series, and the market successfully defended it. So the key takeaway here is that despite all the crazy swings, the market's fundamental structure actually held firm. All right, so if we kind of zoom out from just that Nifty level, the entire day was just a mix of contradictions. It was this fascinating blend of good news and bad news, which is exactly what's making this market so tough to figure out right now.
Let's start with the good news side of the coin, shall we? There was one really clear signal that traders are actually starting to feel a little less scared about what's coming next.
And here it is, plain as day. The India VIX, what everyone calls the market's fear gauge, it actually crashed by 3.5%. When you see a drop like that, it usually means the market is expecting things to get less volatile, which is definitely a positive sign. But just when you think things might be calming down, you get hit with this really puzzling piece of information that just complicates the whole story. I mean, check this out. The Nifty index itself managed to end the day in the green, but its 3 biggest, heaviest hitters, Reliance Industries, HDFC Bank, and ICICI Bank, they all closed in the red. It's like, how does the army advance when its top 3 generals are retreating? It's a really strange signal. And just to add another wrinkle to the whole Reliance story, there's major news floating around that an IPO for Reliance Jio is in the works. Now, this isn't happening tomorrow, but the idea of one of India's biggest IPOs ever could add a ton of long-term value to Reliance, even if the stock was down today. Okay, so we've had this wild day, all these conflicting signals. What on earth does it all mean for traders right now? Where could the market possibly go from here in the next few days? Well, how can we get a peek into the future? Analysts have a few tricks, and one of them is looking at an option strategy called the short straddle. Basically, it's a way for traders to bet that the market is going to stay calm and trade within a specific range. And by looking at the price of those bets, we can get a pretty good idea of where the market thinks it's headed. And when you crunch all that options data, here's the answer you get: a predicted trading range. For the next few sessions, the big money is betting that the Nifty is going to stay locked between 25,700 on the downside and 26,300 on the upside. That's the playground everyone's expecting.
So that leaves us with the million-dollar question, doesn't it? After a day of insane swings, clashing signals, and all this drama building up to the RBI announcement, the options traders are betting on things staying pretty calm. In a market this on edge, will they be right? I guess we'll all have to watch and find out.